All right. Once again, we want to welcome you all to our webinar workshop this beautiful Thursday morning. We appreciate you spending a small part of your day with us. My name is Brian Griffin, a marketing assistant here at Messer Financial Group. Many of you are already familiar with Messer Financial, but in case you didn't know, we are an FMO located in beautiful Mint Hill, North Carolina. We started with just 2 agents, and we are now serving thousands of agents across 40 states, and we're still growing. So 21 years after the Civil War, North American Life was formed. So since then, they have survived the Great Depression, 2 world wars, the Great Recession, and many more calamities, and they're still going strong. So in 2018, they paid out over $431 million in life insurance claims. And now with over 615,000 life policies and annuity contracts on the books, they're still growing. So they maintained an A+ superior rating with AM Best and still have excellent customer service with some of the best products on or in the industry. Now today, we're going to be speaking with Shar Theraldson, an internal wholesaler with North American. Shar has been in her current role for more than 10 years and in the life insurance industry for over 20. She has a wealth of product knowledge, sales tactics, and strategic ways to help financial professionals like you grow their sales utilizing the robust product offerings of North American. Now, before we get started, I want to go over the housekeeping rules. We're going to hold all questions until the end of the presentation. If you have a question, just type it in the box on the right-hand side of your screen, and we'll address your question at the end of the presentation. So now, without any further delay, please welcome Shar Theraldson.
Well, thank you for that, and good morning, everyone. We are all about ready to get ready for our holiday weekend, so I hope everyone has a great holiday weekend with your family and friends, although it's probably a little bit different with all that's going on. Happy to be here on behalf of North American. Like Brian said, we have a strong product portfolio and we are privately owned. Privately owned means I'm one of the owners of the company, and that makes us really different in the industry. Most other insurance companies are either mutual companies or stock companies. So that's what makes us pretty unique in today's environment. And now I want to introduce you to our product lineup. This will be just the life products. And we'll kind of start with the basics of term and then work our way up to the more complex and flagship product of North American, our Index Universal Life. And like Brian said, type your questions in as they come up, while I'm talking about that particular topic or a feature. And then if I haven't kind of satisfied your question just in natural conversation, then we'll address those at the end of the presentation. So here's a quick look at our product portfolio, and we'll kind of take them each individually. We offer 2 different term products, and I'll help you differentiate the difference between the 2. We have 1 UL product, provides a guaranteed death benefit, and then 3 IUL products, starting with one that offers a guaranteed death benefit as well. And the last 2 are focused more on cash value growth. So have a pen and paper handy. You can jot down a few notes about the products themselves. I've prepared or sent items to Brian as a follow-up to the product lineup to share with you afterwards. But let's go ahead and get started. So like I said, North American offers 2 term products. On the left-hand side, we have our classic term, which was a new addition this last year, and then our advantage term, which has been around for a while. Now, our classic term, if you think about it like a classic car, it's before all the bells and whistles were added, before living benefits and conversion. So although our classic term is new, it's kind of what's old again. It's really the bare bones death benefit protection. The minimum face amount on this product is $500,000 compared to our advantage term starts at $100,000. And I would say why we brought this to the table is that because we took some of the bells and whistles off and it's pure death benefit protection, it's ideal for people who need the lower cost coverage, maybe for collateral on a loan, maybe to satisfy a divorce decree and keeping coverage on the other divorced spouse for a period of time. So 500,000 and above, available on a 10 and 15 year. Only available if you do our electronic e-app. Now our Advantage term, on the other hand, this has everything. This has all of the advantages. So comes with living benefits for critical, chronic, and terminal. Those are going to be automatically included on the product as long as the client meets the age and the rate class at the time of issue. It also has very strong convertibility options. You know, conversion is a great transition in the future to move from term to a permanent plan without having to go through underwriting. And then this product too is available through our e-app, which includes our right-away accelerated underwriting process. So we'll talk a little bit more about that as well. But just kind of wanted to put them up side by side. They both offer low costs, but if you're looking for having the living benefits included, which is pretty important these days, and would be considered the new type of term insurance or even life insurance, is to get, when you can purchase life insurance that has the living benefits for critical and for chronic, you'd want to choose our Advantage term. So just real quickly here, I kind of covered this, but the classic term, short-term duration, 10 and 15, lowest cost, no frills, competitive rates, and exclusively on our electronic app, which is our Simple Submit, powered through iPipeline. Here it just stacks up a few of our annual premiums compared to some of the competitors out there, and you can see where we rank, because term really is a price product. People are usually looking strictly at the price, and if that's all they want and not needing the added benefits of the Advantage, then this is where it's at. Now back to that Advantage term. So great way to get that low cost death benefit protection for either the breadwinner or the spouse. It's a basic coverage you can get in place to protect somebody's income for the long run. I would say we're really seeing a run and an increase with term coverage right now in this COVID-19 environment. People more now than ever are saying, you know what, we do need to get that coverage, but they need to keep it budget friendly, and because they might be working, they might, you know, the household income might be impacted because of what each individual, what field they work in. You know, some of their businesses might be closed. So this gets them the low cost coverage, but you want options for the future. And so conversion means you don't go through underwriting again in the future. So if you purchase this term policy 10 years ago and you were super preferred, and 10 years later you've put on weight or had something come up in your medical history and you would have been, you know, standard or table rated, when you convert, you take your rate class that you got on the policy, say 10 years ago, and that moves with you to the new policy. There's no underwriting. Now there's time frames for which you can exercise the conversion, and on this product we have a 10, 15, 20, and 30-year duration. So depending on the age, you could have all 30 years to convert, but otherwise it's up to age 69 or 74, 69 on that 30-year term. But you always have at least 5 years or perhaps the whole duration. And then having that chronic and critical illness included on your term, because so many people think that life insurance is just for that death benefit protection upon death. But what has been added to life insurance policies in especially the last decade or so is the chronic and critical. So if somebody becomes chronically ill where they can't perform at least 2 of the 6 activities of daily living, not necessarily confined to a nursing home, but it's kind of at that point. They could be at home being cared for by a loved one or a family member, or have dementia or Alzheimer's and need that constant care. They can accelerate some of their death benefit while they're living. Now, they're not paying an extra premium to have this included in the product. Actually, how it's paid for is at the end when they actually exercise it. It comes in the form of a discount. So the amount that they accelerate will then be discounted to pay for it at that time. But if they never become chronically ill, they haven't spent thousands of dollars of premiums over the years, to never have needed or used that. Likewise, with critical illness, we have triggers on that. We have 5 triggers. It's cancer, heart attack, stroke, kidney failure, and a major organ transplant. So if any of those events happen, and there could be multiple, so at each event that happens allows them to accelerate a portion of the death benefit for their critical illness needs. And again, those are discounted at the time that they're accelerated. One thing that you'll need to know as we're talking about this here on the term is that I said these are included at no cost up front. But at the time of claim, on the term, we do underwrite for the severity of their chronic or their critical illness. So we will ask for medical records, and we will look to see how severe, or stage of the cancer or the heart attack to determine the level of discounting that will apply. So when we underwrite for the severity for the living benefits on the term, we need to get medical records, and that's going to take a little while, kind of like it does on the upfront of getting the policy. When we get to the permanent plan, I'll explain the difference there. So just wanted to make that point here. Here's kind of where I referenced, the old term, or just even for that matter, old life insurance versus new life insurance. It's a great kind of one-liner to mention to your clients when you're reviewing their in-force or their current situation. Do you have life insurance in place currently? And they're going to hopefully say yes. Oh, do you know if it's the old type of life insurance or the new? And they'll probably say, what do you mean? Well, the new is the living benefits. So it's a great time if they're still insurable to get them through underwriting and get them the new type of coverage that includes the living benefits. I will take a moment to mention, because it's the last one listed on the right-hand side here, is terminal illness. So that's one that's been around for a long time, but worth pointing out on North American is that ours is a 24-month life expectancy. And this is on all of our products. So when somebody is terminally ill and needs to get some of their living or some of their death benefit while they're living, a lot of other carriers might not let the client accelerate that until they're at the point of maybe 6 months of life expectancy, or 12 is pretty common. And I point that out to you because where that could be a differentiator is, think about the clients who are terminally ill, obviously, and maybe there's a study that that their insurance won't cover, and so a drug or procedure that they could try that could be life altering for them, but their insurance won't cover it. And by allowing them to get the funds from their life policy to try that path, and sometimes to get into studies like that of a drug that hasn't been approved yet, they have to kind of be more on the healthier end of their terminal illness than on the final stages. So that could be a differentiator. And also, what if it's that they want to take a trip with their family? Think about how much healthier or able they'd be able to do that at 24 or 20 months versus those last 6 months. They might be very bedridden at that point. So those are just some points I'd like to point out, the difference on the 24-month life expectancy and what that could mean to your clients. Just kind of rounding out this end, and this is probably where we're talking most about the living benefits, but the chronic, the critical, and the terminal, just having that all included, and just seeing that, there's a lot of people that end up filing bankruptcy due to a medical bills and how that impacts their lifestyle. And so just imagine if they could get access to some of their death benefit for those illnesses, we could help prevent those bankruptcies. So it's important to have those included in your products. Here's where you'll see that we stack up to some of our competitors when it comes to term with living benefits, and that there's no extra premium required to have those included in there. And again, term is a price commodity product. So rounding out this section, I think I've already mentioned pretty much all of these. Convertible at any time during the level period. Convertible to any of our currently marketed products. So we don't have a pre-selected product that they can convert to. We don't say that you can only convert to this product. we have two products that offer a longer guarantee as far out to 120, so they could choose to go that direction, or maybe they want to go to one of our cash value products. So the choice is theirs, and 10 years from now, we'll probably have other products on the portfolio, so the choice is theirs. Partial conversions are also allowed. So imagine they have $1 million term policy and they want to convert just 500 of it, they can do that. And then they can keep the remaining 500 as a term, or they can let that go away. They also can use their conversion to increase an existing, say, IUL policy to allow them to put more premium into that policy for more cash value for, say, more retirement, money at retirement. So, so that's a great option as well, and pretty unique from in the industry that North American offers that. And those conversions are fully commissionable. So think about writing a term policy today is really putting inventory on your shelf of a policy that you can come back and visit with your client again in the future and convert and move them into another product right here at North American. I will just continue moving on. We did cover a lot more on the living benefits there, and I'll just point out the differences now when we get into the permanent portfolio. But again, if there was questions that I kind of didn't cover there, get those typed in, and then we'll come back to some of those towards the end. So these next two products, while one is going to be the Universal Life, and then the next one is the IUL, these next two products, the Custom Guarantee and then the Protection Builder, are the two products that offer the guarantee death benefit out as far as age 120. Now we can dial the guarantee back on either of these products, and they're so similar. By the time I get done with this section, you're going to say to me, why do you offer both then? Well, IUL, Index Universal Life, which we'll get to in a minute, is not necessarily for every agent or every client. And so if it feels a little too complex and complicated on talking about the index and the S&P 500 and having money in the index and how interest is credited, then this would be the simplified version of that to get the Universal Life, the Custom Guarantee. So a lot of what I'll cover here will apply to the next product as well. So long-term guarantee, they want it guaranteed to 120 or 100 or 95. We can dial that as necessary. There is, because it's a permanent plan, there is flexibility in the premium options, whether they want a single pay, a short pay, paid up at 65 or 20 years. Now, this product, these would be people that are not concerned about cash value. The cash value element is not even in their vision. It's more about, I just want to lock in the guaranteed death benefit and have it be payable upon my death. Now, this product does offer an option for the future for a change of plans, because nobody has that crystal ball. We don't know exactly what is going to change in the future and how that might impact the client and how they might want something different. So we'll talk about that. And then, of course, the chronic, critical, and terminal is on this product as well. So as far as giving your client more control with this product, basically 3 ways here. We have a premium recovery endorsement. This is kind of our long way of offering or saying return a premium. So we've got return a premium. There's an option at year 15, at 20, and 25 for them to get some or all of their premiums back. So that's one of those crystal ball predictions. We don't know. Maybe 15, 20, 25 years from now, they really need the money versus leaving a death benefit for their heirs. So at year 15, they can get 50%, 50, of their premiums paid back. We'll send them a letter and say, the policy you purchased had this premium recovery endorsement. If you no longer need the coverage, you have a 60-day window to sign here, cancel your policy, and get 50% of your premiums paid back. Now, the year before, at year 14, there's no surrender value. There's no exit strategy. And at year 16, there's none. It's at year 15, a 60-day window. And then the same thing will happen at year 20 and 25, a 60-day window where now they can get up to 100% of their premiums. And it's important to explain that it's up to 100% because on our older clients in this product, when and their higher premiums that they're paying and typically a lower death benefit, the most that they're going to be able to get is 100% of their premiums, but it's also capped at 50% of their death benefit. So if their premiums paid is greater than half of their death benefit, then it might catch you off guard, and you might wonder why it's not 100% of their premium, but it's capped at 50% of the death benefit. So that's an exit strategy built in. You're not asking for this, it's built into this product. The next one is this guaranteed exchange privilege. The easiest way to explain what this is it's pretty much exactly like the conversion I just explained on the term. So because you could think of this product as a term for life because it has no cash value and it can go out to 120. So if this client later decides that they want to have cash value, they can exchange it and not have to go through underwriting, and they can move into one of our cash value products, which will be the last two of our IUL products, the Builder Plus and the Smart Builder. So this is another exit strategy, no underwriting, they trade it in and go to the next policy. And so great option. And again, the only predetermination that we make on that is that it has to go to a cash value product, not back to a term, and not to our other product that offered the guaranteed death benefit, because that's what they're moving out of. And then of course the accelerated death benefit endorsement for chronic, critical, and terminal. And the only thing that I'll point out that's different here, again, they're included up front on the policy at issue. And I don't think I gave these to you yet, but this would apply to the term as well. So chronic is going to be included as long as the client is age 80 or younger at issue, not at the time they make the claim, but 80 or younger at the time of getting the policy. They also have to get a table 4 or better offer from our underwriters to have chronic included. Now to have critical included, the issue age is 75 or younger, and they have to get a table 2 or better offer from the underwriters. So again, those will be included at no extra charge. They're there if they need them. Everything else works the same as far as like even the terminal and 24 months. One thing that I would say that's different on the permanent now is that we do not underwrite for the severity of their chronic critical illness at the time of claim. So this is a much easier, simple process at the time. If they have a heart attack, we just need the doctor to sign and say they had a heart attack. And then we can have a check cut probably within a week to 10 days. Same for chronic illness. We just need the doctor to certify that they, need supervision, they can't, eat and dress themselves, and then they can accelerate. Again, this would apply to what I talked about on the term. For chronic illness, you don't have to be confined to a nursing home. You don't have to provide us with receipts. You can use the money to make improvements to the house, such as maybe wheelchair accessible, maybe modifications to the bathroom, etc. It could be used to help pay for somebody to come in and care for them when the loved one can't be there. So a lot of flexibility. And one thing that I didn't mention the first time I talked about it is that, and again, this applies to all of them, is for chronic, you can accelerate up to 24% of the death benefit each year. So you could take less, but the maximum is 24% of the death benefit. But you can keep doing that year after year until 5% of the death benefit is left. So we have to keep 5% of the death benefit intact to pay when death actually occurs, and then that's all considered tax-free of the death benefit being paid out. All right, and for the critical, because we don't underwrite for severity here, for critical, for a cancer, heart attack, stroke, etc., the max they can accelerate is a flat 50,000. There is a percentage too, but 50,000 based on their death benefit. And then because we don't underwrite for the severity, the discount is they'll get 40% of what they accelerate. So if they accelerate 50,000, they're going to get a check for 20,000, but they're going to get that in a matter of a week to 10 days. Now, you might say, well, that's a little bit of a steep discount. but they are getting it fairly quickly. We're not underwriting for the severity of claim and saying that, well, that wasn't very severe. It doesn't have a major impact on your mortality going forward. And getting $20,000 in their hands could help them with maybe lost wages while they're out of work, maybe to help with out-of-pocket expenses from their health care, from their health insurance. So just want to point that out. Next, we're going to move into the first of our IUL products, which is our Protection Builder IUL. Now, almost everything that I just told you on the previous product is going to apply to this one, except for that guaranteed exchange privilege. And I'll explain why that's not even necessary or needed on this product. And then we'll compare and contrast the two. So our Protection Builder, if you've been with us in the past, this product was previously called our Guarantee Builder. We just changed the name. It does offer better protection. So in addition to having the guaranteed death benefit like the custom guarantee, it has the potential for cash value because it's an IUL product. In fact, when we run the two illustrations, let's just say we were looking for $1 million of coverage on a 60-year-old, we're going to get the same exact premium on this product as we will on the previous product I just mentioned. So think about it. If you were going to buy a car or a TV and you were presented with two different TVs, let's say, and this one TV had all the extra bells and whistles that you wanted, but it's the same price, it's kind of like, well, why wouldn't you go with this one? They're the same price and you get all this extra. So that's kind of the position that I would have to you here, not only in comparison to our GUL, the custom guarantee, but to other guaranteed death benefit products out there. If you can get all these extras, why wouldn't you go with this product? So box on the top left, guaranteed death benefit cash value. Box on the top right, those are our living benefits that we've already talked about. Those are included. I'm going to move down to the bottom right, premium recovery endorsement. That works the same as I explained it on the previous product, year 15, 20, and 25, getting some or all of the premiums back. But because there's cash value in this product, if the time for them to need cash came in year 13, this is an IUL product. There could be more or at least some cash value in the product because it's an index product in year 13. And they wouldn't have to wait till year 15 when 50% of the premium option is available. So if the actual cash value is better than the ROP, well, then they have access to that. And then it wouldn't have to be permanent. They could take it as a loan or withdrawal and still keep the policy in force. So that is also included. The protected death benefit, we call that having your cake and eating it too. This is actually on all of our IUL products. So from this product forward, we have a feature built into our product that once you get to year 15, once the policy is 15 years old, so it'd be day one of year 16, and the client is at least age 65, so they have to cross both of those thresholds, they can use a portion of the cash value to pay up and protect a smaller amount of a death benefit. So kind of a reduced paid up, they can kind of lock that up in the policy, and then any remaining cash value in the policy they can have access to and take it as a lump sum or ongoing, but this way they know that they always have a certain amount of death benefit protected. So rather than waiting until the very end, like using an overloan protection feature when you're taking loans, and then maybe only having, like, say 5 or 10,000 upon their death, this could be somebody that says, you know what, I need to make sure I always have 100,000 payable to my family upon my death, but now I have all this cash value in here. I'm gonna use some of this in my retirement because my index performance has been so well all these years. So a lot more flexibility and options within this product. And like I said, the premiums are same for the client. The target premium for which your commissions are based, that's going to be a little bit higher in this product. So it's a win for you and it's a win for your client. Now here's just a little bit of, you can see kind of where we stack up to our competitors. as far as the annual premium, and then having the living benefits included for no extra premium, and then the ROP option. So this, when we use this product, the default is to have the premium guarantee rider in there, but that actually is optional. So if you're looking for a for just the cash value growth, we can actually disable the premium guarantee rider, and then we have a little bit lower fees inside of the contract, and just have a focus on cash value. That will lead us nicely into our flagship IUL product, which is our Builder Plus IUL. This is the product that we use, I mean, almost always. It has great death benefit protection and high income potential. So it has this, when we have an interest multiplier in there, higher caps, and interest rate bonus, this can really help grow the cash value inside of the product. And this is what we're using all the time for retirement planning, for college funding, even a combination of the two. I myself am an owner of a previous version of this, the Builder product, and I have my 21-year-old son in a product like this as well. So we're overfunding it. It's our cash savings vehicle. We can take money out to buy a car, a down payment on a house. We can just let it grow. We can take it at retirement, you know, or college in the future. So just lots of options in this product. So let's see a few of the bullet points here. It's for the long term. You know, there's a 10-year surrender charge period on this product. So yeah, it's all IUL products are usually more heavily charge in the first 10 years, but you need to think about this for the long term. And that's why I'm glad I got my son started on it so early. By the time he starts looking at the cash value, he's going to be past that 10-year surrender charge period. People who are looking for tax and risk diversification. So money that is going into these products is after-tax dollars. And when we take that money out later by way of variable loans in the product, that's all coming out tax-free. It's a nice element to add to your retirement portfolio. So if your 401k is down because of what the market has done recently and you were needing to take money out, if you take that money out when the market is taking a turn for the down, you're kind of locking in those losses. So maybe that's a year that then you would take the money from your life insurance policy instead, and give the 401k or other vehicles a chance to rebound a little bit. And then taking money out of here where it's tax-free instead of all of it out of a 401k where it's going to be taxed when you take it out. You know, if you kind of mix and blend a little bit of that, you can reduce your overall taxes at that point in the future. So a really important piece to have as part of the retirement planning. And then of course we've got the chronic and critical in here, just like we've discussed on the other products. The features that are included in this product that really help the cash value performance is, first of all, top left, we have an account interest multiplier. So this is applied to what the index does. And it's guaranteed to be applied at a 10%, but currently right now we're offering 15% in the first 10 years. So for example, like illustrations that we run right now, we're running at a rate of 6.27. And if we apply and multiply that times 1.15, so an extra 15%, even though the index did 6.27, their final crediting rate is almost a percent higher at 7.21. So that helps increase the actual crediting rate over and above what the index actually did. Now, once we get to year 11, moving to the right, we have a 1% guaranteed interest rate bonus that's applied. So effectively, because the floor is 0 each and every year, once we get to year 11, because we're always going to give them a 1% bonus, so in a down year, if it's 5% loss, the floor of 0 comes in, but then they're going to get a 1% bonus on top of that. So it's effectively raising the floor, but it's still considered a bonus and applied above the floor. It's also applied above the cap. You know, the cap on this product right now is 10.25. So if the index grew 15%, we'll cap it at 10.25, but if we're in years 11 and beyond, we'll add another full 1% to that. So if we back up for a second and let's go back to the multiplier, let's say that we're now in year 11 and our multiplier drops from 15 down to 10, but our bonus kicks in. So in that same example, 6.27 from the S&P 500, for example, times 1.10, which is our 10% multiplier, puts us at 6.9. And then when we add the 1% bonus, now our crediting rate is at 7.9. So you see guaranteed on here, guaranteed at 10% for the multiplier, guaranteed on the 1% bonus. The only thing that the multiplier doesn't work on the money that's loaned out, and then the multiplier would not have a positive impact if it was negative in the market. So if it was a 5% loss and then we apply the floor of 0, if we try to give them another 10% multiplier on 0, 10% times 0 is still 0. So it doesn't work in a down year, but all the up years it does. So this really helps the cash value really start performing, especially in year 11, but I mean, it's working for them too in years 1 through 10. So that is our flagship product. Here is just a couple examples. The top half, we have it illustrated at the maximum rate, the 6.27. And actually, it looks like this needs to be updated. It was based on our previous cap. So 6.46, these numbers are showing. And then the bottom one is just showing at 5%. One thing that I'll mention here is you see for the death benefit option on the left-hand side here, let me see if I can get, so you can run, when you're usually running an IUL for maximum income, usually people would use increasing death benefit and then change it to level when they're done paying. So say somebody's 40 and they're going to fund their policy for 25 years, then in year 26, they'd want to, you, the agent or the client, needs to remember to change it to level. And that's how you would get the lowest death benefit to start, and then you'd get the highest income. When we introduced this product a couple years ago, we added the return of premium death benefit option. Instead of the death benefit increasing by the cash value in the policy, it increases by each and every one of their premiums that they pay. And if it's increasing by each premium that's paid, then guess what? When they stop paying premiums, it stops increasing and nobody has to do this change to level. And so if we compare the top line with the middle line, so their death benefit started at say $350 compared to now $400. So they get about $50,000 more of coverage by starting with this one. So let's see what kind of impact does that have on the loan later. Relatively nothing, $55,548 or $55,260. So it has very little impact on the income later. Minimal impact here. There is an impact here for you for target premium. So this again, when you're looking, kind of like I said before, when you're looking at 2 TVs and you get more and it makes it easier, you don't have to have some gadget attached and remember to do something 25 years from now. This seems like the best solution. So I pretty much almost always run my illustrations with the ROP now. There are some scenarios where increasing still works better, like on juveniles or the real young individuals. But if you're really trying to maximize this money later, because if you forget to change it to level, this number right here is going to be even lower than all of these numbers. So just wanted to point that out. That's an important feature. Let me change my cursor, and we'll just we're kind of on the downhill as rounding this out. Most of these apply to all the products, but we'll just touch on them here real quick. We already talked about the protected death benefit. That's that reduced paid up option. Moving down from there, we do have a premium deposit agreement. That's available on all 3 of our IUL products. So the Protection Builder, the Builder Plus, and the Smart Builder. Premium deposit agreement is a funding vehicle. It helps take a single premium and spread it out anywhere from 3 to 10 years. It's kind of like putting their money in a CD here with North American, because we lock in the rate and then it's going to fund the policy each year. So currently you're locking in at 3 1/4, and then you choose the 3 to 10 years. It's there to help prevent a policy from becoming a MEC with a single premium. This product has low premium loads. It's a 5% premium load. That's a fee with each premium paid. So just want to point that out. All of our IULs have daily sweeps, meaning each day that is a trading day and that we receive premium, we move their money to the index account immediately. Some companies only do it once a month, once a quarter, or even once a year. Index credits are based on the full beginning segment value. That means, so index segments run for 1 year. So if we're paying a premium today, July 2nd, it goes into the index, and then next year on July 2nd, we'll look at this is for a point-to-point example, what was the value of the S&P today, and what is the value of the S&P 500 next year? And that's what determines the growth. Now, when we apply, say, that 6% or whatever it might be, what's different for us is we go back and see how much money was in the index on July 2nd last year versus what's left in it after 12 months COIs have come out. That's a big differentiator over time on a policy. Other carriers will credit it on what's left in there. And then index credits on the first annual statement. Any premiums received in the first 30 days, that first index segment will be cut short so that we can apply an index credit on the first annual statement. And that's really important, because otherwise your client gets nervous that they had money for a year and didn't have any credits. Whereas otherwise it might show, you know, a few days later and then be captured on the following year's statement. All right, the last product that we have to cover here is our Smart Builder IUL. If you've been with us before, this product was previously named the Rapid Builder. Rapid Builder, the word rapid was used because it built cash value more quickly in the earlier years. And that was mostly due because there's 0 premium load. So I just said on the last product, 5% of every premium is taken off. This one, no percent of the premium is taken off as a charge. You also have the ability to get rid of the 10-year surrender charge period on here. But this is a product that is used taking those single premiums that your client may have in a CD, savings account, and really leveraging it into a death benefit to leave a legacy, but yet because of the cash value growth, the 0 surrender charge, giving them the liquidity if they need that money, because people are probably leaving those larger sums of money in a CD or savings account because of the accessibility, and it's not tied up, and if they need it, they can get to it. So that's where we see this product really being important to our portfolio and for our clients, is that for those that want to have access, but if they don't need it, they do want it to pass on to their beneficiaries tax-free. And then, of course, the living benefits are included here as well. So the waiver of surrender charge rider, that's optional. It can be added. It doesn't have to be, but if it is on that short-term play and you want to erase the 10-year surrender charge period, you can get rid of that. Accelerated death benefit endorsement, variable loans, it's in year 1. Actually, that was available on the other 2 products as well. Return of premium death benefit option, we talked about that, and a 10-year surrender charge period. The example I just explained about somebody having money in their CD and you could leverage it into here, we talk about that as those are unemployed assets or lazy money, and we talk about repositioning that and making that money work a little bit smarter for them. And so that's a smart money sale that we talk about. Other concepts that work well for this kind of niche product is business planning. You know, a business owner who has its cash flow is important to them, and so they don't want to have money locked up behind surrender charges either. And so having that surrender charge erased would be ideal in this product. And then policy review, people who are moving from an old product to a new product and don't want to start a surrender charge period over again, maybe this is ideal for their 1035s. So lastly, I just got a couple of final slides here, and then we'll see what kind of questions. North American has made huge steps when it comes to technology. We do have, so Simple Submit is our electronic e-application. And when you take the application for your client through e-app, and especially in our current COVID-19 situation, having a face-to-face meeting with your clients probably is not happening or very much anymore. So doing the e-app, you can fill everything in over the phone with them, and then send them an email, and then it will have them electronically sign, like put in data to identify themselves. And when you do that and it comes in, they can then qualify for our right-of-way underwriting, which means clients who are 18 to 50, applying for up to 1 million, they could potentially get approved without having to provide 1 drop of blood or a urine specimen or having that paramed exam. So it's our accelerated underwriting program. And for the ages 51 to 60, those clients applying for up to 500,000 could potentially qualify and get approved. I myself did this on my policy 2 years ago for my extra term policy, and within 24, 48 hours, I was approved. So it's very slick. So this is really just the kind of a summary of the products that we went over today. We talked about the classic term, no frills, the advantage term, having the extras, the bells and whistles, the living benefits, and the conversion. Then we moved into our 2 guaranteed products, both offering the recovery, premium recovery endorsement, one without cash value and one with. And then we talked about our flagship IUL product, the Builder Plus 2, ideal for the retirement planning. And then Smart Builder, that early cash value or leveraging dollars that are lazy into a smarter play for both them and their beneficiaries. And then, you know, for you, you've got a diversified product portfolio, so you don't have to write the term one place and then the permanent another. It's actually more beneficial if you write the term here with North American because of the convertibility and increase options you have later. Some of those, we talked about the innovative benefits that are included as far as the premium recovery and the accelerated benefits, death benefits being included. Multiple solutions. I mean, I don't expect you to remember exactly what I said about each product today, but we do have a site, and I think that's the one I shared with Brian as a follow-up, is that where you can go to our marketing toolkit, and it'll kind of help guide you what you're looking for to help you remember and decide what product to go to. So asking your clients, sharing these solutions with them, and then getting results. So with that, Brian, I'll just leave my contact information here. I'm the internal wholesaler for the Southeast region. Gary Proco is the regional vice president. We're here to help and assist you, but Brian, let's see if there's any questions we need to take care of for these people today.
Absolutely. Thanks so much, Shar, for that information. I mean, just a ton of great information for our agents here. And we do have a few questions that I'd love for you to answer. So the first question is from Juanita, and she says, what are the issue ages for the term products?
Great question. So age 18 for the term products. And actually I mean, you can go up to, yeah, so I think she wanted the minimum issue age, or is she looking for the maximum as well?
I'm going to assume both. She just asked what are the issue ages.
It's going to depend on, so like the 10-year, we can go up to age 75. The 15, we can go up to age 70. Okay. The 20-year up to 65. And on the 30-year, we have 2 ages, depending on if they're tobacco or non. So non-tobacco on the 30-year, we can go up to age 55. And for tobacco, it's to 50.
Okay, great. Have there been any adjustments? No, this is my question. Have there been any adjustments as far as COVID is concerned? I know that we've had some carriers that are adjusting their ages as far as cutoff at 70 or 72 or something like that.
Yeah, the only cutoff Well, the only straight cutoff that we made is at age 80 right now. So we were
Awesome.
taking clients up to age 85, but with COVID-19 right now, 80 and above, we're not gonna underwrite. Those would be postpones. The ages below that, and I can send you this. I'm not sure if I sent it to you before, Brian, but we have a COVID-19 landing page. And for the
Mhm.
other ages, we have implemented, like maybe for, maybe the max we'll offer is a table 4 if they're in this age range. So then those ones would turn into a postpone. But 80 is the cutoff right now just because of COVID, and I'll send you that link, Brian.
All right, great. Thank you. And the next question is, can you explain how the convertibility works? Is it converted based on premium or face amount?
Um, Yeah, so I guess it depends what they want to go to. So when you're doing a conversion, and let's go back to that $1 million, and now they're saying, well, I want to have 500,000 guaranteed, to age 100, and this was going to run out at age 70 for me. So so then they're saying I want this amount, and so since they have a full million that they can convert, they're choosing just to take 500, and then we'll have to go and see what that premium is. Or
Okay.
maybe the client says, you know, how much could I have guaranteed to age 100 if I pay X amount a month? Well, then we maybe find out that that's based on their budget, it's 300,000. So I mean, it's based on what goal or what their new goal is that they're trying
Oh,
to achieve.
wow.
Um,
Okay. So that's good to know. So so it's not tied to what they're currently paying, what that would convert to in the other product. So basically,
no,
it's
because
what their goals are and what they want to go to.
yeah, because the premium on the term is going to be relatively small, and that's probably why they started
Right.
with that. And so, if it's that now they want to put $200 away a month in the Builder Plus, so they have money at retirement. Well, then we could go over there, and then we could solve for the death benefit, and maybe that comes up to be 165,000. I mean, it you can pivot from anywhere at that point, anywhere up to the $1 million of coverage that they had at that point in this example.
Awesome. So next question is, can the Builder Plus IUL be written on a child for the purpose of college savings?
It can. So our index or our permanent plans, you can write a policy as soon as the child is 15 days old. Um, for college planning though, I would say you're for a juvenile, about the most we're going to consider is about 250,000 for say a newborn or even a 5 or a 10-year-old. Um, and then there's premium limits based on what the IRS says you can put in there. So yeah, if you're starting the policy when they're a newborn, you're going to have the most time to get money in there and have maybe something at college. But really, the whole idea of college funding is if something happens to the parent who's funding this policy on the child, then it doesn't make it a self-completing plan if the life insurance is on the child. So really, it should be on the parent or a combination of the two. Like I had a client, or they were asking me the other day on a 13-year-old. Well, 13 to 18, there's not a lot of time to get much money in there to take out for retirement, or
Right.
not retirement, for college.
Mhm.
Um, and there's premium limits. The IRS doesn't just let you put on, as much as you want into those policies. So if you can start earlier on those children, the better. But ideally, it should also include a plan on the parent.
Absolutely. And as far as the agents are concerned, who would they reach out to, or what's a resource for them for more in-depth training on the Builder Plus?
So I'm the internal wholesaler, so I would be able to help field those questions. If I'm not available, we have a sales desk that can back up in my absence or availability. Um, we have the marketing toolkit site link that I've sent or shared with you. There is a host of recorded web sessions out there where you can choose kind of like one on the builder and on retirement, and you can view and listen to those. So we have a lot of also videos on our YouTube channel. Again, a lot of that stuff is linked from that marketing toolkit site.
Okay. Awesome. And the last question here is, what products is the right of way available?
So actually the right of way is available for all of the products we covered today. It's
Awesome.
But in order to be eligible, you have to do the electronic app, and then it has to be in those ages, 18 to 50, applying for $1 million or less with North American, and 51 to 60, applying for 500,000 or less.
Okay, great, great. So, Shar, thank you so much for the information that you went over with us. In closing, is there anything that you want to say to the agents that are on with us?
Uh, no, I mean, I thank you for your time today. I thank you for your interest in North American. As you can see, we have a broad and yet complete and compelling portfolio designed not only to meet your clients' needs now, but how they might change in the future. So we're very proud about the way we design our products and our strength and stability for, the past 130 years we've been in business and what the future holds as private ownership. We're here for the long haul, and so we'd love to have you on board with us. So I hope you all have a safe and happy 4th of July weekend, and I'll leave it with that, Brian.
Thanks so much, Shar. And once again, I appreciate everyone that has taken time out of your day to join us. Hopefully, you learned something new about North American and their products. It's going to help you build your business. Now, if you're not contracted with North American, please make sure that you go into your SureLC portal and you request them as one of your carriers. Also, if you're someone that's not familiar with Messer or you're not contracted with us, definitely give us a call. Speak to someone within our marketing department at 866-568-9649, extension 7819. Or you can email them at mfgmarketing@messerfinancial.com. Anyone will be more than happy to answer any questions that you do have. Then also take a moment to check out our events calendar at messerfinancial.com. We have webinar workshops just like this scheduled throughout the year with valuable information like Shar just shared with us. But once again, I want to thank you all so much for joining us. Please take care of yourselves and everyone around you. Have a great day. Have a safe holiday.